preparing to buy your first home, you've probably realized something pretty quickly. This process is a lot more complicated than you expected. Between the unfamiliar terminology, the different loan options, and all the numbers being thrown at you, it can feel overwhelming fast. And one of the most confusing parts, your monthly mortgage payment. Today, we're breaking it down in simple terms so you know exactly what you're paying for. And so you're not surprised when the real monthly number is higher than what you saw online. Let's get into it. When most people look at the mortgage calculators online, they're only using two components, principal and interest. Let's define those first. Principal is the amount of money you borrow from the lender. If you purchase a $300,000 home and finance the full amount, your principal is $300,000. Interest is the cost of borrowing that money. It's what you pay the lender in exchange for financing your home. Let's look at a quick example. Imagine you purchase a $300,000 home using a 30-year fixed-rate mortgage at 4.5% APR. If you plug those numbers into a calculator, your principal and interest payment would be about $1,520 per month. That sounds manageable, right? But here's the problem. That's not your full mortgage payment. Not even close. Your true mortgage payment includes more than just principal and interest. As a homeowner, you're responsible for other recurring costs, and many of them are rolled into your monthly payment. The most common ones are homeowners insurance, property taxes, private mortgage insurance, if applicable, and homeowners association dues, if applicable. These are called variable components, and they can significantly impact what you actually pay each month. Instead of asking you to pay these large bills all at once, lenders typically collect a portion of them each month and hold the funds in what is called an escrow account. An escrow account is simply money held by a third party. Each month, part of your mortgage payment goes into this account. Then, when your property taxes or insurance are due, the payment is made on your behalf. It helps you avoid a surprise $3,000 or $4,000 bill in one lump sum. Let's look at each of these in more detail. 1. Homeowners insurance. Most lenders require you to carry insurance on your home. This protects the property in case of things like fire, theft, or storm damage. 2. Property taxes. These are annual taxes assessed by your local county and state based on your home's value. If you live in Florida, for example, you may qualify for the Florida Homestead Exemption, which can reduce the taxable value of your primary residence by up to $50,000 and cap annual assessment increases. That can make a big difference in your long-term costs. 3. Homeowners Association, HOA dues. If you live in a neighborhood with an HOA, especially condos or townhomes, you may have monthly or annual dues. Sometimes these are paid directly by you. Other times, they're included in escrow. HOA dues often cover amenities or maintenance, but they can add several $100s per month depending on the community. 4. Private mortgage insurance, PMI. If you put down less than 20% on your home, your lender may require private mortgage insurance. PMI protects the lender, not you, in case of default, and it adds to your monthly payment until you reach enough equity. Let's revisit our original example, which included only principal and interest. That payment totaled $1,520 per month, but did not include our annual variable costs. So let's estimate those costs now. Homeowners insurance, $2,000. Property taxes, $3,000. HOA dues, $1,200. PMI, $1,500. These annual variable cost estimates total $7,700 per year. Divide that cost by 12 months, and that's about $642 per month added to your payment. Now let's combine everything. Principal and interest, $1,520. Annual variable cost, $642. Your actual monthly payment, about $2,162. That's more than $600 higher than what many online calculators initially show. And this is why so many first-time buyers are caught off guard. Before you fall in love with a house, it's incredibly important to understand your full estimated payment, not just the principal and interest. Because affordability isn't about the listing price, it's about the real monthly cost. Sitting down with a lender early in the process allows you to run accurate numbers, estimate taxes and insurance, factor in PMI if needed, and understand how much home fits comfortably in your budget. That way, you can shop confidently and avoid disappointment later. Buying your first home is exciting. It's also one of the biggest financial decisions you'll ever make. And you don't have to navigate it alone. If you have questions about mortgage payments, escrow accounts, down payments, or the home buying process, our home loan team is here to walk you through it step by step. We're here to help you grow into home ownership with clarity and confidence. If you found this helpful, make sure to like this video and subscribe for more financial education content designed to help you make informed decisions. And if you have any questions about mortgages or home buying, drop them in the comments below. We'd love to answer them in a future video. Thanks for watching.